little different than the retirement board meeting, Kathy.
You know, no, it's fine.
We're a tiny little
this
group.
whole hybrid thing's been quite creative.
Yeah.
We were back on site for the first time in 2 years last week.
I knew, yeah.
Yeah, it was like, and we were all over the board, all over the place. So it was not up, we were not all up on the dais because it's not big enough to spread us out. So.
We're live. We're live?
Yes.
Hey, good morning, everyone. Our live feed has started, so thank you for joining the Deferred Compensation Advisory Committee meeting. Today's Thursday, January 27th, and it is just now 10 o'clock. We're going to start with welcoming our new committee members, and then we'll do roll call. We have 3 new committee members today for 2022 and beyond. Our first one is Supervisor Robert Rickman. Supervisor Rickman is replacing Supervisor Miller. So welcome, Supervisor Rickman. We're happy to have you here.
Thank you. Glad to be here. Good morning.
Okay, just so we're clear, we're being recorded. Our second one, as this team may recall, we recently did our new election. Thank you, Tammy, for new participant members. So Kathy Herman is joining us from SJ Sarah. Sorry, Kathy, I cannot look at you and not think Stan Sarah.
That's okay.
Kathy is joining us from SJ Sarah as our participant representative, and then our alternative participant representative is Stephen Hopkins from the assessor's office. So he will fill in if either Christine or Kathy cannot be here. So Tammy, will you do our regular roll call, please? Oh, Annette. Oh, Annette. I'm sorry, Annette. Will you do our regular roll call?
Yes. So, Christine Babb.
Here.
Kathy Herman.
Here.
Fonse Kyokum.
Present.
Robert Rickman.
Here.
Jay Wilberding.
I'm here.
Jeff Wolfcamp.
Here.
And Stephen Hopkins. He's on mute.
He was.
Steve's muted.
Okay, we'll go back.
I'm here.
So thank you, everybody. We're excited to have some new committee members. We're excited for your input. There's a lot going on right now that Tammy will talk about later, but we're very appreciative of you being here. Our first agenda item for today is approval of the minutes for the quarterly meeting from July 29th. And I will need a motion and a second from the committee members and a vote from the committee members who were present on that day.
Madam Chair, this is Jason Council. Just to interrupt, for purposes of the roll, I know that you're operating the meeting, but just for clarification of the record, could we get an affirmative that you are in attendance as well as you are a member of the committee?
Absolutely, I'm here. Thank you, Jason.
Brandy Hopkins in attendance. Thank you.
So our committee members who were present at the July 29th meeting was myself, Brandy Hopkins, Christine Babb, Nancy Calkins, Fonse, our tax collector, Supervisor Miller, CAO Wilverding, and Jeff Wolfcamp. So I'll need a motion and a second from individuals who are present, and then we'll do our vote.
This is Fonse. I'll make a motion to approve the minutes.
I'll second.
For the record, that was?
Jeff Wolfcamp, second.
Thanks, Jeff.
Thanks, Jeff. So Annette, can you do the roll call? Since we're virtual, we need to do an actual roll call.
Okay. Christine Babb.
Aye.
Kathy Herman.
Kathy, we have those who are present.
Oh,
She can abstain. This is Jason. She can abstain if she's so inclined, and probably I'd recommend she does.
I abstain.
Thank you, Kathy. So you see him at the top? Do you want me? I can do it, Annette.
well,
Yeah, and go ahead and ask everyone and leave it to them to make the decision as to whether to abstain or not. Council recommends you do so, but
Thank you.
make sure everyone that's in attendance for the meeting, the vote should be taken.
Okay, so you got that, Annette, or would you like me to do it? I'll do it.
just list their, read out everyone who's here, right?
Yeah. Okay.
So Christine Babb. You already said yes.
Aye.
Kathy. Fonse. Already, sorry.
Yeah, go to Fonse.
You could do, okay, Fonse.
Aye.
Fonse? That's
Made the
fine. Go
motion.
ahead. Fonse made the motion.
So Supervisor Rickman,
I'll abstain.
you. CAO Wilberding,
Yes.
and I'll say yes. So we can move on. The minutes are approved. Thank you.
5-0.
Next is public comment. So our public comments are limited to 250 words or less, and they may be submitted by emailing, bear with me for a second, sjccac publiccomments@sjgov.org. Annette, do we have any public comment?
No public comment.
Okay, we do not have any public comment for this morning. So we'll be moving on to our program status report. This is an informational report from Empower. Bob?
Yes, thank you. Good morning, everybody. If it's all right, I'll pull the reports up on screen.
Please.
Okay, I'm going to start off with the fourth quarter 2021 plan summary report. We'll go through this. As you'll see on this first and second pages especially, there is a comparison to third quarter numbers as well. The 9/30 numbers are in the first column and then the 12/31 numbers. So we're looking at a snapshot in time here. At 12/31/2021, plan assets were at $540 million roughly. That was an increase of about $17 million over the third quarter ending balance of $523.5 million. Total outstanding loans increased by $288,000 to $1.9 million. You can see participant contributions in the next section. In total, about $664,000 came in participant contributions compared to about $485,000 the previous quarter. Profit sharing, that would be county contributions, about $249,000. And then in the section below are the distributions. Withdrawals and terminations were up over the previous quarter. In total, about $10.4 million for the fourth quarter compared to about $7 million in Q3. Again, terminations would be lump sum withdrawals leaving the plan. Withdrawals would be every other type of a withdrawal, including periodic payments to retirees. Loans, loan fundings, about $452,000, and then you see plan expenses, and finally investment income. It was a positive quarter. About $22.2 million in earnings came in compared to a slight negative for Q3 of about $931,000. Looking at the second page of the exec summary, you see total participant count. Participants are up a total of 80 net participants on the quarter. Average account balance is up about $1,600 to $84,171. Average number of investments holding pretty steady, around 4.4. Number of outstanding loans up to 156. That's up 17. Percent of participants with a loan is 2. Average loan balance around $12,693. Just a quick comment here. Your loan program is still relatively new. 2% of participant population with a loan is pretty low. And again, that's reflective of the fact that it's fairly new. Typically in a mature plan, one that's had loans for say 5 or 10 years, I would typically see percent of participants with a loan around 8 to 10%. So just kind of a heads up that there's a lot of room for growth. Again, typical would be somewhere around the 8 to 10% range. And then down below, you see the activity, calls into the 800 number, as well as visits to the website for the quarter. In terms of plan activity, we're looking specifically at the 457 plan. You can see fund by fund, the activity. Beginning balance as of 9/30 is displayed here. Ending balance at 12/31 is the second to last column, and then the activity that took place over the quarter is in between. Not a lot of notable changes here. The general account or the GIA remains the number one investment option. About 30% of the plan's assets are invested in the general account. Collectively, your target date investments, the T. Rowe Price target date series of funds, if you add up all of these percentages, it's just under 18%, 17.85 is invested in the target date funds. That would be the second largest investment option if you look at them collectively. Continuing on to the next page, you see the remaining funds in the portfolio. And on the bottom here, the total plan assets, 540 million at 12/31, compared to a starting point of 523 million at the beginning of the quarter. 401A plan activity, kind of a similar story here. There's a smaller percentage of assets in the general account, but still significant. 14.5% roughly is invested in the general account. If you add up all of these percentages for the target date funds, it's about 20%, 20.31 to be exact, are invested in the target date investment offering. So in the 401A plan, the target date funds would be the top holding. A close second would be this T. Rowe Price large cap growth fund, and then Vanguard Institutional Index. So actually the general account is the fourth most popular option in the 401A. And then continuing on to the next page, you see the remaining funds in the portfolio. I'm going to skip over this page because it really is just the graphical version of what we just went through in the executive summary. Asset allocation, this is showing you in the 457 plan by type of account, whether someone's an active employee, it's a beneficiary account holder, someone who's retired or terminated, or a quadro account. Those are broken out here. And then you see the number of participants invested in each investment option as of 9/30 and then as of 12/31. And this far right column is the one I like to spend a little time on. This is investment selection. So we took a look at the last payroll that we received in the fourth quarter. And this is how the payroll that was received was allocated into those investment choices. So 18.1% of the payroll received went into the general account or the GIA. And then you can see fund by fund how that mix looks. Again, the target date funds collectively, if you add all those up, it's 53.4% of the payroll allocation went into the target date funds. So over time, if that trend continues, obviously, the target date funds will be a larger and larger portion of your overall portfolio. And then you see the remaining investment options here.
Bob, this is Tammy.
Yes.
Since we have 3 new committee members, maybe you might, can you explain what a quadro is in case they do not know?
Oh, certainly. Quadro stands for Qualified Domestic Relations Order. Essentially, when there is a divorce situation, the account, as directed by the divorce decree or the court, is split into 2. So the quadro account holders would be the ex-spouses, their portion of the account. There's an account that's established in their name, and a portion of the balance is moved into that account. So those would be the quadro account holders.
Thank you.
Thanks for the question, Tim. And then moving ahead to participant average balances, you're getting a snapshot of the total portfolio broken down by age group. Across the top here, you see under 30, age 30 to 39, and so forth. So as you look down the page, you get a sense of how each age group is allocating their assets. And really what we're looking for here is just general trends. If things look appropriate, or if there are any alarm bells that are sounded. Certainly no alarm bells here. As we look down the page, the under 30 crowd, not very much is invested in the stable value investment, which is what you would anticipate. There's a heavy allocation. This red bar refers to the asset allocation life cycle, or those would be the target date funds. So heavy usage of target date funds for really people under 40. You can see the 30 to 39 group, very heavy allocation to target dates as well. But the conservative, lower risk investments, the younger someone is, the less you would like to see invested in those categories. As people get older, you would like to see them become more conservative over time. And this chart is certainly illustrating that. You can see this lighter blue bar that would represent stable value, or the more conservative investment in the portfolio. And as people are getting older, they're certainly increasing their allocation to the more conservative investment choices. So just a kind of a general look at the entire population on this page. Another chart on asset allocation, we're looking really at people, how many investment options they hold in their portfolio. 62% of the population has one investment option. Now, having one investment option is still just fine. If that one investment is a target date fund, you're considered to be very diversified still. You could see 5+ investments, 22%, and the other percentages in between. If you take that one wedge, the 62% that just have one investment, that's what this center chart is doing. It's looking just at that population, and we're removing those people that are in target date funds. We're not worried about them, because if they're in a target date fund, they are considered to be diverse as far as their asset allocation. So of that percentage of the population that has one investment, that one investment not being a target date fund, how are they investing their money? 88% of those are in the stable value fund. And going further to the right, of that group that's just invested solely in the stable value, what is their age grouping? And you can see about 82% of that population is over the age of 50. So again, a sign that the more conservative investments are being utilized most heavily by those who are either in retirement or nearing retirement. Participant interactions, just taking a look at calls into the toll-free 800 number, website activity, and it's pretty consistent. This is for the fourth quarter. The next slide is the third quarter numbers, and not much changes between those two. You can see heavily skewed towards website in terms of people checking in on their account. 34% just checked in on their account balance. Another 34% roughly looked at a statement of account. Another 10% balance summary, 7% loans, and then balance transfers would be about 6%. So that's what people did when they logged into the website, or the chart on the left when they called in to the 800 number. And then lastly here is a report of activity. And this really is David McCrae's activities. And David, since we didn't meet with the committee last quarter, if you wouldn't mind maybe summarizing your activities for both the third and fourth quarters of 2021.
Sure. I see on the screen it does look a little small for myself. I'm not sure if the others are able to see it, but that's just fine. The big number to look at is in the lower right, the total attendees. So either from a group meeting or an individual meeting, I met with, my face was in front of 2,700 employees in the last 12 months. So that's probably right up there with our highest numbers, despite everything being virtual. The big difference from 2021 compared to other years is that usually it's pretty equal between group meetings and individual meetings. And last year, most of the meetings were in a group session where I'm talking to multiple people at once, usually about enrollment or maybe the retiree seminar or the National Retirement Security Month or an event like that. Most of the meetings have been shifting to group. It is, of course, for some employees, they're still reluctant to speak to me over a Zoom meeting or something like that, but we're figuring it out. Starting in July, I started trying to return to some on-site meetings. So if you look kind of in the middle of the screen where it says Q3 2021, I have 3 categories in that box, and it says virtual individual meetings, and 22 days of virtual individual meetings were conducted during that time. But there were 3 on-site meeting days at departments that requested I meet with them on site, and we made sure we followed all proper procedures to have masks on and be distant and everything. But we were only able to hold 3 of those successfully. And then group meetings in that quarter was also a little low. But that was kind of offset by fourth quarter down below that, where we had a lot more group meetings, in part due to National Retirement Security Month. And that was a really high total number of participant interactions. In total for last year, of the 751 people that sat down and spoke with me, 87%, sorry, not 87%, 47% of everyone who sat down and spoke with me took some kind of action of changing their asset allocation or saving more or doing a rollover or enrolling or something along those lines. 47% of all the individual meetings in action took effect. In total, I enrolled 466 employees last year. So I know if you look on the first page of these charts, it will say, well, this is how many were at the beginning of the quarter, and this is how many employees there were at the end of the quarter. Well, people did retire over that time, but in total, 466 enrolled in total. Most of that I would like to say is attributed to me, but of course you hired physicians and they really don't have a choice. They have to participate, but I would still interact with them. When Bob was referencing the chart by age group, where everyone by age group, what they're investing in, you can see on that the enrollment process that we've created over the last 16 months. It's become very efficient on making sure employees are enrolling in the target fund, and they're familiar with how to change that. So we're at about 65% of the younger employees being in the target fund, and you can see that natural glide over time on the 12th page, where as you get older, you get more comfortable or want to get more involved in making those investment decisions on your own. So overall, I would say last year, despite it being mostly virtual, we figured out how to slowly start getting back into on-site things, and it was, I think, quite successful. I'm very happy about the number of enrollments above all else, and of course, the number of interactions in general. Any questions, anyone? Thank you.
All right, thank you, David. And now I'll just flip over. The committee has been interested in rollover out activity. This is the Q4 report. In total, there were 29 transactions, 5.7 million in assets were rolled out. From a comparison standpoint, in Q3, we had 44 transactions and about 5.4 million rolled out. Q2 was an extremely heavy month for rollovers out, 11.7 million with 57 transactions. And then Q1 of 21, 5.1 million with 41 transactions. Q4 of last year, 2.8 million and about 30 transactions. So that's where the kind of the trend has been. And this is the current report.
Bob, this is Fonse. I got a question. Not really
Yes.
a question, but more of a comment on Q4.
Yep.
You see that one disbursement at 1.5. I know Randy and I spoke about it before. Again, the assumption was that's probably a physician contributing the maximum amount in the beginning of the year over 30 years. Yeah, I ran the numbers on that, and it's like they would have to earn almost, I think it was 7 or 8% consistently throughout the years. I mean, that's just, I guess it just amazes me, and I wouldn't mind seeing what that person did to be able to achieve that amount with the maximum limits and everything. But
the other thing, Fonse, is a good point. The other thing to keep in mind, you're just looking at the amount of the distribution, and what we don't know, I guess, from looking at this is if there was a rollover in at one point from, an IRA or some other source for that person. It wasn't just contributions and earnings, but it could have been monies that were rolled in as well.
But I'm assuming that even with the IRAs and everything else, everything has a limit of what you could contribute, right?
There's a limit as far as what you contribute each year, yes, but
Correct,
there's no limit as far as a rollover coming in. Could be of any amount. Correct.
So again, it just amazes me with that number. I think my question is actually, I know that this is probably in an Excel spreadsheet. Is there a way we could basically look at where the monies are going and say, hey, you know what, all the money that's being transferred out is going to Great West Trust? Is there a way we could kind of determine that and say, okay, these are our top 3 locations that people are transferring their money out to?
Yeah, we do have the reports. If you would like it, are you asking for it in the Excel format? I'd be happy to provide it.
Yeah, that'd be interesting. Or could you just provide it in general to the team here? The reason why I'm asking is that, is that company doing something special that we don't have? Is that the reason why they're taking their money, or is it again? I'm just trying to figure out why it's going, and is there something we're not doing to prevent it?
Yeah, no, good question. I can certainly consolidate, a year's worth of reports or 2 years worth, whatever you think would make sense, and kind of, do like here's the, well, I'll break it out by where it's going, and then you can see exactly how much money went to what company, say, over the last 12 months. The third quarter report is right here. It's a longer list. We just didn't have, on that fourth quarter report, there were a couple of transactions over $1 million. This one doesn't have any over $1 million. I see an 864 here, an 881 here. So there are a couple of big ones, but nothing over $1 million. And you can see where they're going. But yeah, I'd be happy to do that, Fonse. I'll put together. Do you want to see like the last 12 months?
I think maybe the last 2 years would be good.
2 years? Okay.
Yeah, that's fine.
Yep, I can follow up with that.
I think Mr. McCray has his hand up.
Yeah, I'm trying to follow the Robert's Rules of Orders and all of that. But I'd like to add, of the rollover outs last year, 32 of them were not participants. They were quadros, or they were beneficiaries. The person had passed away, and then this person inherited the account, and they said, well, I want to spend it, or whatever the situation might be. So yeah. a decent chunk was not employees, and in regards to that large distribution out, that employee had worked here a very long time, and they were, like you said, very consistent about saving money. So it can happen. If only it could be public or something. You say, look, people save money and it really helps them over time. But we don't live in that kind of world. But it would,
like I said, that person
way
should
more
be
successful than me.
That person should be the poster boy or girl. Again, maybe
100%.
say, yeah. Say, Maybe we don't need to put a name on there. We just need to say John Doe or Jane Doe. This is what she did or he did, and
if you look at that person's department, they were the kind of person that would grab the younger employees and drag them in front of me and say, "You look, I saved money. You should save too." So on a department level, you do have that person every once in a while where they say, "This was such a success, and I'm glad I did it all those years ago."
Yeah.
Are there any other questions for Bob or David?
No.
Okay. Thank you. We'll move on to our next informational item. We're going to have our quarterly performance review for third and fourth quarters of 2021 from our highest group. Vincent, I'm looking for your square. Oh, there you are.
Great. Thank you very much. Let me see if I can share my screen, and hopefully you see in front of you the San Joaquin County December 31st report. Okay, I do have the third. Thank you. I do have the third quarter, but because third quarter is baked into the fourth quarter, unless anybody has specific questions about the third 3-month period in 2021, I'll just highlight the things in the fourth quarter. So as a way of background, Highest Group is a company that I work for, similar to Empower with David and Bob. We are an outside vendor, business partner, however you want to view our tasks and role on advancing the plans. The key distinction between Empower and Highest Group is that the Highest Group is a co-fiduciary. And this is a good reminder for the existing committee members, but just important to point out with the new membership. And that really means, despite the fact that the county is a client, the pool of participants are really what we're advocating for. To set another way, every recommendation that we make has to benefit the group of participants in the plans. And so we take that role very, very similar to the membership of the committee, Brandy especially. So a little bit of background, I grew up in Woodland, California, outside Sacramento, so about an hour north of you. My office is in Portland, Oregon, but we counsel about 150 clients similar to the county on the West Coast. We have about, I think, a quarter of the California counties. Most of those I report to. So similar to San Joaquin County, we have a lot of clients in your neighborhood. As I go through, if there's anything that you really want to highlight or me to pause, I really encourage you to ask questions. Typically, how I go through the report, a lot of data points are similar to Empower's, and so I will do my best not to repeat what Bob has already conveyed, but we lay it out just a little bit differently, so I might highlight/repeat the same data points that you've already seen. But let me go into our report. I'm on page 3 if you're not following on the screen. I want to just touch upon a couple leading economic indicators very, very briefly. Let me pull up something here. Okay, the first one is in the upper left. It's the gross domestic product, or GDP. Most economists view this chart or this data point as a good barometer of our economic output or economic activity. The black line is the dollar value of all the goods and services produced in the country in a given year. And you can see there was a huge sell-off or contraction in GDP with the onset of the pandemic. Large chunks of the economy shut down. And then in response, we had seen a tremendous support from the federal government with money flowing through the system. We had some optimism around vaccine statistics. We've also had a very, very aggressive Fed keeping rates low. And so you see that recovery here. And the nice thing is the GDP number came out for the fourth quarter this morning. I don't know if you saw that, but it's 6.9%. If you recall, a healthy economy grows anywhere from 2 to 3%. So a 6.9% number is pretty good. However, with an expanding economy, we have seen a hint of inflation. Hint is my euphemism for a spike. I will just touch upon the inflationary number in a second, but briefly, I want to go just in order the unemployment rate. The unemployment rate spiked at 15%. A measure of full employment is an unemployment rate of 5%. Nationally, given all this the optimism that I talked about, we have seen the national average go down to 3.9%. There in the county, it's a little bit higher at just over 6% at the latest read, but still relatively healthy economically speaking. So let's move down quickly into the consumer price index. This is an inflationary guide. And as I said, we have seen a spike in the prices that we pay for haircuts, hamburgers, cars. Really everything has seen a significant increase in pricing. The Federal Reserve has an explicit inflationary target of 2%. The latest read is 7%. This is the highest inflationary number since 1982. Some economists view the inputs of food and energy as too volatile. So there is one gauge where we strip out food and energy, and we call that core CPI. That number is 5.5%, but that's the highest it's been since 1991. And what we typically see with an overheated economy is represented by a spike in inflation, is the Federal Reserve moving aggressively from low interest rates to higher interest rates. In fact, there are 4 interest rate hikes priced into the market this year by the Federal Reserve. And the reason I bring that up is because bond math, and I'm moving from page 3 to page 4, bond math states as interest rates go up, the value of existing bonds go down. And that's exactly what we saw last year in 2021. You know, you had the 10-year treasury below 1%. Right now it's about 1.8%. So with the uptick in interest rates over the longer end of the yield curve, we saw a weakness in the bond market as represented by the line here. Second line down, upper left. The broad bond market index is the U.S. aggregate managed by Bloomberg. Essentially, if the nightly news ever reported on the bond market here in the U.S., this would be the index that they use. And you can see over the last year, it was off over 1.5%. So a stodgy conservative bond market can lose money where interest rates spike, and that's exactly what happened in 2021. So we saw some weakness in the aggregate, but the flip side is this index here, which is the TIPS or Treasury Inflation Protected Security, with the uptick in inflation, was actually a beneficiary of that, up almost 6% for the year. And then last but not least, this high yield or junk bond index, you can see up over 5% for the year. So the broad index lost money, the TIPS and the high yield index rose quite considerably. So that's the good news. Moving to the next page, I want to talk about the US stock market. Given the environment that I talked about, the optimism with the economies expanding, low interest rates, the S&P 500 or Standard & Poor's 500 did very, very well. You can see up almost 30% last year to the tune of 28.7%. That's the US stock market. About 45 countries outside the US have an investable stock market. So on page 6, you'll see that index represented here. The upper left first line is the ACWI or ACWI. That stands for the All Country World Index minus the United States or ex-US. You can see for the year up almost 8%, 7.8%, which is pretty nice, just not as nice as the US stock market. And I want to highlight one thing. It was muted not so much because of the performance of the underlying indexes or the countries, it was because we had a strong dollar. So if you think about it this way, if we're an American tourist overseas, we want a strong dollar because it buys more goods and services. It's the exact opposite with an American investor overseas. In fact, I want to highlight this one-year bar chart. The index for the year was up almost 19%, but because of the strong dollar, as we translate that into American earnings, let's just say that 18.7 gets shrunk down to 11.3%. And that's the effect of a strong dollar or a weak foreign currency, whether we're a tourist abroad or an investor here in the US. So I'll pause before I get into the plan. Any questions, comments? Okay, hearing none, I'll go ahead and skip that page and move into section 2 and bring this down a little bit. Similar page that what you've seen before in Bob's Empower report, but we lay it out just a little bit differently. And so I want to highlight this very, very briefly. We take all the investment options in the 457 and then group them by asset class and then rank them generally in risk order. And so you have the 5 funds in the green header or fixed income, that's the bond. This is that guaranteed interest account or GIA that Bob was talking about. You have the 2 intermediate term bond funds, one managed by Metropolitan West or MetWest, the Vanguard Index Fund, and then this DFA Inflation Protection Security. This is that fund that invests in those TIPS products that I was talking about, and then the TIACREF High Yield Fund. And then rounding out this column, you have funds that invest in large company, funds that invest in mid-sized companies, and then funds that invest in small cap companies. And then moving into the right-hand column, you have 2 funds that invest on the international markets that I talked about. You have the target date funds managed by T. Rowe Price. These are those broadly diversified portfolios in one investment option. And then you have funds in the specialty category. One invests in real estate and the other in gold and special minerals. The dollar amount and then the percentage is not what the fund performed. This is the overall makeup of the plan or the portfolio. And back to Bob's point, you have about 30.5% of the assets in that GIA. About a third of the plan assets are in large companies and about 17% in the target date funds. This dollar value of $542-ish million, very, very nice growth rate over the years. And you can see that. I know Bob compared it to last quarter, but I want to touch upon where we took over in 2018. It was $385 million. So significant growth rate thanks to market gains. And what we do, similar to what Empower was presenting, we do look at a cash flow. So you can see here for the period, $6 million went into the program. However, $11 million left. And it was exactly the conversation between David and Fonse, you know, rollouts, deaths, retirements, whatever it is, you had more money leaving. And that's a consistent trend that the committee has talked about over the last couple of years, is developing strategies on way to either increase the money going in or decrease the money leaving, because you can see for the year, the plan was net negative from a cash flow standpoint, and that followed the trend in 2020, albeit a lot less, and then 2019, also a lot less. The good news is the market has gained significantly to counteract any net negative cash flow situation. So I'll pause, see if anybody has questions so far. All right. Hearing none, I'll keep going. Moving into the 401A plan, you can see same menu, obviously different asset size as well as different asset allocation. There's a lot more money in the large cap funds, a lot less in the fixed income funds. And then about the same in the 457, there's 20% in the target date funds. And then this is $26.5 million. At the end of 2018, there was about $13 million here. You can see that. Different cash flow dynamics just because of the participant base in the 401A, and the dynamics are different. But look at this, nice average account balance at just over $182,000. And then moving into the next section, this is where we take all the investment options and the characteristics of the funds across the 2 plans. We screen those characteristics against the metrics in your investment policy statement. In fact, this somewhat intuitive high-level page is called the Investment Policy Statement Compliance Report. And hopefully all the characteristics comport or pass those metrics, and it shows a green P. Anything worthy of note is going to show a red dot. There are a couple funds that we placed on watch previously. The Allspring Special Mid-Cap Value Fund was placed on watch the early part of last year. And then the American Beacon International Equity Fund was placed on watch in 2020. You can see those are no longer showing red, but there are 2 funds that, given the internal structure, are showing. I will just pause for a point of clarification. I know the agenda item said this was informational only. If we were to place funds on watch or to remove those, would that require action from the committee or on the agenda, or is that more of an internal highest decision to place funds on watch or remove them? I guess maybe Jason, if that's a question to you from a process or formality standpoint.
I think from a process or formality perspective, Vincent, as this is an advisory committee, I would encourage, any discussion that needs to take place. And whether with the direction of the committee or without, the plan administrator, Brandy, can make that call after discussing it with you.
Okay. So with that, I think I'll spend 2 minutes talking about the funds, the 4 funds that are either on watch or should be on watch. Is that okay?
Please.
Yes, please.
Okay, great. Thank you. So the first one, well, actually, let me take a step back. Almost similar to the Quadro, it's a term that we use regularly that the new committee membership or even maybe the existing membership doesn't know about. Watch status is a term of art in the retirement plan industry to really bolster the process of the committee in their oversight of the investment options. And so watch is merely a formality in exercising prudence and process in the monitoring of the retirement plans on a regular basis. So I know watch may connote negativity, even the red dots may, but it's just a point that we're not going to focus on the funds that are showing green peas. We're going to focus on the funds that are violating the metrics. And the good news is there's nothing really wrong with these 2 funds. There's just a certain level of change or a disconnect in the market that I just want to explain what watch means. So let me explain what's going on with MetWest or Metropolitan West Total Return Bond Fund. Back in 1996, 3 fixed income or bond professionals formed this firm by the name of Tad, Brian, and Steven. Tad was the chief investment officer or CIO, and towards the later end of 2021, he announced he was leaving the firm. Steven and Brian, who are the co-managers of this particular fund, moved into the co-CIO capability. We have been in regular contact with Steven and Brian, and nothing other than Tad's departure has changed. The process flow, the management of the fund, everything is solid and status quo, and we are very, very confident with the current state of affairs with this particular fund. However, when a CIO departs a firm, we think that's worthy enough to place this fund on watch. Granted, we will be in regular contact with the team that's left, but right now we are very, very optimistic that given no changes internally with the fund, that we will take this particular fund off of watch status over the next couple quarters as Tad's departures does settles. Moving into this particular fund, I talked about the high yield or junk bond portfolio. This is somewhat of an oxymoron, but TIAA-CREF, even though it invests in junk bonds, they invest in higher quality junk bonds. And so with a very, very low quality rally that we've seen in 2020 and 2021, this fund suffered for it, but the weakness it showed in previous years actually caused it to do very, very well over the last quarter. Nonetheless, even though we're comfortable with the portfolio investing in higher quality junk names, it does violate the metrics over the long term because the last couple of years' performance dragged down the longer term numbers. So our recommendation right now is to place this fund on watch as well, but we're very, very confident that this fund will recover, and hopefully over the next maybe 2 to 3 quarters, we can take this fund off of watch. But right now, it's violating metrics. And it's a similar story. Moving down into Allspring. Allspring Special Mid-Cap Value Fund used to be known as Wells Fargo Special Mid-Cap Value Fund. At the beginning of 2021, Wells Fargo announced that they were spinning off their asset management arm to 2 private equity funds. And similarly, just like this significant management change, anytime there's significant ownership change, similar to Allspring and Wells Fargo, we place this fund on watch. Given the fact that this dust has now settled and we're very, very happy as predicted that nothing has changed, this fund management is exhibiting the same very, very good portfolio characteristics when we hired them, our recommendation is to remove this fund from watch status. And similar to the story that you heard with MetWest. And then last but not least, American Beacon International Equity. This also experienced significant manager change, but also some performance issues. As predicted, this fund has emerged from both of those and is no longer showing red. So our recommendation is to remove this particular fund from watch status. A lot of information, especially maybe for the new membership, but hopefully I explained everything succinctly, but I'll pause to see if anybody has questions on those 4 funds specifically or any other fund in this particular report.
Vincent, it's Tammy. Over the overall report. So a couple of days ago, the U.S. Supreme Court ruled regarding fiduciary responsibility. Does this report and your watching of all these investments make that so that we're in compliance?
Absolutely. And I was actually going to mention that in the next agenda item, but since you raised it, should I explain exactly what happened with the Supreme Court and the Seventh Circuit?
I would like you to, Vincent, but before we do that, can we talk about the funds and whether they should be on watch or not? Because everybody just heard your comments.
Yeah, absolutely.
Are there, from the committee members, are there any other questions or comments related to what Vincent shared regarding the 4 funds, the 2 that he's recommending to put on watch and the 2 that he's recommending to remove from watch?
No, I have no questions.
Supervisor Rickman, do you have a question? I don't think so, but your name popped up.
No, I'm good.
Okay, thank you. It's probably just the computer. I just wanted to double check. So Jason, should we take an advisory vote from the committee for Vincent and myself's knowledge?
Well, here's my recommendation instead, Madam Chair. Since it's not on the agenda for an action item, I would not take a vote. However, and given your authority, in any event, what I would recommend is, assuming that you go along with Vincent's recommendation, which is what I gleaned from the committee's silence, just make sure that it is clearly stated in the minutes. If you do it well, it'll be in the minutes. Let's not worry about that. I apologize. Just make sure at the next committee meeting, you report that the action was taken and any resulting consequences therefrom.
Okay, thank you, Jason. So we will follow Vincent's recommendations. We'll make sure that's in the minutes and we'll report out at our next meeting. So Vincent, would you like to jump into the next agenda item about the legal and regulatory updates?
Yes, but can I just put a pin on that for about a minute and a half? I do want to, for the committee as well as the new membership, just explain the rest of this report very briefly. So you'll notice that there are 2 columns. One is performance or quantitative factors. The other is qualitative, and it covers the ownership, management change, maybe an increase in fees, a decrease or increase of assets. We are monitoring almost every facet of these investment options and reporting those to you. The next section is the performance of every investment option. And again, the satisfaction or violation of all the performance will roll up into that stoplight chart that I talked about. But this will be a good segue into the U.S. Supreme Court case. One of the fiduciary responsibilities is not just the menu structure, it's not just the performance, it's also the fees. And so as a co-fiduciary reporting to the committee and Madam Chair, we're also on a quarterly basis publishing the fee structure of the 2 plans. And so you as a committee member will always know on a very rough basis what the annualized fees are to invest in the plan. But also it's our job as the outside consultant to make sure that these fees are reasonable. And that's where, again, if any time that they're not, they're going to be reported back on that page so that we can take action, whether it be to place a fund on watch or to remove a fund. And we've done both of those in recent history. But unless anybody has questions on the fees, maybe at the next meeting, I'll do a deeper dive in this. But it's the menu structure, it's the performance, it's the fees. There are a lot of responsibilities for the committee members. And as the outside consultant, most of that falls on us. And so now can we move into the Supreme Court case?
I want to make sure that the committee doesn't have any questions about the fee.
Yeah, thank you.
And Vincent, that would be helpful if we could do that at the next meeting.
Okay.
I don't hear any questions, so yes, please move on to the legal and regulatory updates.
Okay, and I'll leave it on this page because it is a good foundation to the U.S. Supreme Court case. So there were a few participants in a retirement plan at a university. It's Northwestern University outside Chicago in Evanston, Illinois, and they were unhappy with their retirement plan. And they felt that the fiduciaries overseeing the program could do better, so they sued. The Seventh Circuit said that because there were some good funds and some bad funds, participants had a choice, but the problem was there were about 400 investment options across a plan. You can see here there's about 25, and I'm just eyeballing, but this particular plan had 400 investment options, and true to form, there were some good ones and some not so good ones. And so basically the Seventh Circuit agreed with the plan sponsor, in this case, Northwestern University. Plaintiffs appealed to the Supreme Court, and the Supreme Court said that doesn't matter. It's not so much that you can have good funds alongside bad funds and participants can choose. You as fiduciaries and stewards of other people's money, you have to have a very, very solid retirement plan, menu, structure, performance, and fees. And so basically the Supreme Court ruled that just because you have a sliver or a big chunk of good performing funds alongside bad ones, you're responsible as fiduciaries for the entire menu. And so essentially the Supreme Court sided with the plaintiffs by remanding that case back to the Seventh Circuit to apply, there's a case called Tibble, to apply the Tibble standards, meaning that the fiduciaries have to have a bulletproof from A to Z, run the gamut, that it has to be, fees need to be reasonable, performance need to be in line with metrics, and there needs to be a prudent process. So back to the point, you have a very slimmed down menu, best in class. The performance, although not perfect, you're going to have some very, very, very high quality funds over the long term that are good DC friendly firms, meaning that there's not a lot of volatility in the particular investment options. But also too, you have the consultant reporting on and making determination that the fees are reasonable. So I'll pause there to see, Tammy, did I answer your question, or any other of the membership have questions or comments on that particular case?
You did, Vincent. I was just wanting to make sure. I thought that this report does that, but I just wanted to make sure that we were addressing that decision.
Any other questions from the committee for Vincent? Okay, thank you, Vincent. We'll move on to our next item. Our benefits manager is going to provide a status of post-employment health plan, our VEBA transition.
Thank you, Brandy. So good morning, afternoon, everyone. As most of you are aware, this committee desired to conduct an RFP for record-keeping services for the deferred compensation program, and also the administration of the post-employment health plan, which is also known as a VEBA. So a subcommittee of this group, along with HIAS and the county's purchasing division, conducted an RFP, which was released in July of 2021. And then through that process, Nationwide was chosen as the new service provider. And this is scheduled to occur in late April, early May of 2022. However, we were informed by Empower that the current VEBA platform was going to be disabled and going away. And so we had to change to the Empower platform in January, which was going to require that the VIBA participants actually change platforms twice and transfer their funds twice. And we just didn't think that was administratively feasible. And so we did have Empower and Nationwide work together so that we could transfer early in January so that this would not occur. And so I just wanted to let everyone know that that did happen. We went to the Board of Supervisors last week and it was approved on consent. And so that process is now complete. Funds were transferred to Nationwide, and Nationwide has sent out correspondence to all of the participants. And I actually sat with one of our HR employees and walked through the setting up of her account. And so I do know that those letters went out and it was very easy process. So I just wanted to bring this committee up to date on the VIBA transfer. And then now that that is complete, we're now focusing on the record keeping service transition. We anticipate going to the board on March 1st if we get all the agreements and documents fully vetted. And then we plan on sending out multiple communications to ensure that this is not a surprise to any of our members. I just do want to also state that when we did the VIBA transfer and also when we do the record keeping transfer of funds, we are including notice to the unions. And then with that being said, I think we're pretty much up to date. We have standing meetings. We do have a 2-hour transition meeting next week with Nationwide. So that is in process. And then Vincent has been key working with me on this process. And so Vincent, do you have anything to add to the process and the progress we've made?
No, as always, you did a great job. The one thing I do want to not be remiss, and sorry to step on toes if this was going to be, I just enjoyed working with David and Bob from Empower. And again, these transitions are not always easy, but I just want to thank them for their participation, not only over the years, but in this process. But Tammy, you summed up everything up nicely.
Thank you. And I echo, it's going to be tough. I've been working with Bob and David for many, many years. So thank you for all of your help through the years.
Are there any questions or comments from the committee related to the VIBA transition or our pending record keeper transition?
So are you saying that David and Bob are leaving?
The committee chose another record keeper, yes.
All right, thank you. Sorry.
No, we do
also like to echo those comments. Dave and Bob, again, it's been great working with you guys. So again, I'm sure we'll see each other around.
Thank you, Fonse. I think we all echo those sentiments. Is there any other business from any of the committee members this morning? It's morning still. No? Okay, we're going to do a final public comment check.
No public comment.
We have not received any public comment. Our next meeting is Thursday, April 28th, 2022 at 10 a.m. And we will release the location once it's been secured and pending any COVID protocol changes. Thank you, everyone. Our meeting will end today at 11:03. Thank you for your time.
Thank you.
Thank you, everyone.
Bye, Bob and David and everybody else. Take care.
Bye-bye.